Welcome back, everybody, to another episode from Coin and Capital. It's Chris here, bringing you headlines, research, data, charts, price action, whatever it may be to help you better understand financial markets. We talk about it, we break it down, and we try to find truth. This week, a little bit inactive. Was sick for most of the week, lost track of time, but we're back to discuss the markets, to discuss the US. We're going to talk about some repo stress. We're going to talk about some liquidity. And finally, we're going to talk about Bitcoin and what is going on in the markets. If you guys stick around through the video, I'm also going to show you some more of what I've been building. This product I'm looking to roll out beginning of next year for you guys to help you guys synthesize all the noise, distilling it down into pure signal. I think you guys are really going to like it. Stick around and you'll maybe get to see a sneak peek. Anyway, let's get right into the video. Okay, right off the rip, guys. I'm a little late, forgive me, but the government shutdown in the US has ended. I don't know, honestly, what was going on down there. I'm up in Canada, but it seemed like for the last 2 to 3 weeks, the government had its panties in a twist and shut down for some reason, causing a tremendous amount of issues, especially in the financial markets. I saw that EBT ran out as well. Riots in the streets. People are pretty unhappy. And the markets are also very unhappy with all of this. A lot of uncertainty. People are saying this is the top. Maybe we're all cooked. Let's actually look into what's going on behind Mr. Donald J. Trump here. Okay. Few charts so we can understand what has been going on. Bottom right here, we have the TGA. So the Treasury General Account, the checking account of the United States government, which has been on the rise pretty much all through this government shutdown. Okay, because the government has been shut down, they have not been able to spend down the TGA into the economy, and it's grown to, it's like 950 billion, pretty close to $1 trillion. Okay, now keep in mind the TGA, this guy right here, is a prime driver of liquidity short term in financial markets, in the economy. So when they cannot spend that down, right, when the TGA rises, it actively removes liquidity from the markets, which has led, top left, SOFR, overnight funding rate. This and this are directly correlated. Why? TGA rises. Okay, liquidity gets pulled, reserves are squeezed. Okay, and this funding rate right here is the rate people get paid to hold cash overnight, collateralized by US Treasuries. Okay, this funding rate spiked. This funding rate spiked because reserves dried up, right? Because of this TGA refill, it caused friction in the financial system, and repo rates started to dysfunction pretty much. There was not enough liquidity to take the other end of these treasuries. Long story short, so what happened was they had to inject $50 billion to keep the repo markets from imploding, right? To subsidize the demand for treasuries, because there was not enough liquidity to go around. When repo rates start to blow out, that is the clearest sign that there is dysfunction in the market, and something needs to be done to fix that, right? Because we don't live in free market capitalism anymore. We, in fact, think we need to rely solely on the Fed to come and save us from our mistakes. So the Fed gives money, injects liquidity, smooths over, but still the markets dysfunction. And this dysfunction in the back translates pretty heavily into sentiment across investors, across traders. into crypto Twitter, which has seen what I think is the largest mismatch between bears and bulls. Okay, if you guys go on Twitter right now and look at the sentiment in crypto, it's terrible. It is so bad, guys. I don't think people source their information well enough during these market cycles, especially because market cycles tend to undulate and are never fixed. The 4-year cycle is never fixed, right? It extends, it contracts, all these kind of things. So no cycle, top to bottom, is the same. And where a lot of people have been getting thrown off is we seem to have this interim year where things just go sideways. And people don't know what to do. Nobody can seem to sit on their hands and hold quality spot positions. They need to be doing something, which has led us to one of the biggest discrepancies, imbalances, mismatch, and sentiment, and ultimately leading to some pretty asymmetric positioning if you're willing to take it. So on the right, if this cycle is like the others, we have less than a year until Bitcoin finds its bottom. Don't forget to take profits. I don't know why people are still comparing last cycle to this one, this cycle to the past cycles, when everything about this cycle is fundamentally different. People who understand what's going on tend to take a more positive outlook. It's not that I know the market will go up, it's that I know if it does, alts will almost immediately be 5 to 10x what they are, easily, on the low end. There's plenty of reasons 2026 could be the biggest year in crypto ever. You'll never see this risk to reward anywhere else. Take it or leave it. Couldn't have said it better myself, Alex. Guys, do you not pay attention to the news? To these fiscal policies being implemented? To the fiscal bills being passed? Institutions are finally getting the regulatory green light they need to go all in. There's trillions of dollars of capex being pipelined into the US. QT just ended. And many, many other reasons. And people are calling top. People that have no idea how to synthesize data together to provide quality insight are calling top. Meanwhile, we have people like Julian. Julian does some incredible work over at Real Vision. Him and Raul are some of the top thinkers, in my opinion. They've produced some of the best work on this cycle, on liquidity, on the business cycle, all that kind of good stuff. So if you guys do, go check out Julian and his work. Extremely helpful, extremely sophisticated, and it describes a lot of what's going on. And so from Julian, we have the global M2 overlaid against Bitcoin. Okay. What is this showing us? Global M2 contracted, which means Bitcoin's price will inevitably contract, which we're living through right now. Why? Because Bitcoin is the purest expression of monetary debasement, and monetary debasement is expressed in global M2 rising. So, as the world expands the money supply, Bitcoin only follows suit. And Julian has highlighted here a nice wedge pattern in global M2, currently retracing before a new leg up. And yes, that leg is coming. That leg is coming. That's not just a random line drawn on the chart. Look at the news. First of all, distill the news you intake. Look for fiscal policy. Look for capex. It's all there, guys. It's all there and it's going to happen. It needs to happen. That's what people don't understand. This needs to happen. Back to Bitcoin. Okay. We're looking on the weekly chart. Honestly, not bad. Okay. Not bad for where we are and what's been going on in the past few weeks, right? We've had some massive OG sellers selling over like $40 billion. And we're still just hanging out 95,000. Okay. That is not bad, right? That is not bad as all these new coins get redistributed. That is not bad considering repo markets almost exploded earlier this week. And that is not bad considering we have had a contraction in global M2, or a plateau, so to say. Let's look a little deeper. Coming to a desktop, to a laptop near you in 2026, it's the Palfrey Limited dashboard. This has been, I've been working so hard over the last month and will continue to work so hard to bring this to you guys as soon as possible. But what we have here is the magnum opus, the meta synthesis of all my proprietary models I have been developing and working on, distilled into simple scoring to bring you guys some of the most actionable, easy, accurate insights into the market. Okay. And so this score, that plus 0.5, is made up of a bunch of different things. Okay. We have our global liquidity index, which is a composite of a variety of factors, all relative and measuring liquidity globally. Okay. And that has been on this plateau, maintaining the positive phase. Okay. Next, we have the liquidity engine. So repo markets and then ETF flows, distilling how that liquidity actually flows into the crypto markets. Okay. Now, because the repo markets blew out earlier last week, this one is where the issue lays. Okay. Liquidity is there. It is going to rise. However, the transmission between point A and B, so A being money printers, B being crypto markets, is sketchy right now. Meaning liquidity can't fully flow in as need be. Finally, we have the reflexivity scores and then collateral usage and leverage in the system. Now, all of these models can be scored on their own individually to give us reads, short-term, long-term, medium-term, whatever it need be, for certain aspects of the market. And then they also get synthesized into a total score right here, 0.50, with a regime assigned to the degree of scoring. Super cool, right? So now that we have the 0.5 scoring, the regime here is maintain and accumulate on dips. Meaning the cycle is not over, guys. If the cycle was over and the top was formed, most of these signals right here would be flashing red. And this total score would be sub 3.5, essentially. That's how we read that. And we're not yet in the euphoria phase because most of those signals right here on the right would be extremely green, pushing 7.5 plus, and this total scoring would be doing the same, pushing 7.5 plus. So when we tap back into Bitcoin chart, what we can understand is that we need to be buying discounted Bitcoin, discounted alts, and preparing for the next leg up. So if you guys enjoyed this video, make sure to drop a like, hit that subscribe button, drop a comment down below. Let me know what you think of that model I showed you. Let me know what you think we should cover here more on this channel. As always, catch you guys in the next one.